click start recording. I think we're good. All right. Good evening, guys. Thank you for your patience. This is Ken at Tortoise Capital with the strategy podcast for August 16th, 2020. So before I get deep into the market health check and then into quick review of the day at a glance, and then I have 6 intraday trades that I want to demonstrate today, because they were really quite a variety of the kinds of price action that you can see on any given day, and you can see how the rules get applied based on what the different price patterns are going to be. It's the same rules, but the outcome's a little different because the price acts differently. So I just thought today was a really good example on an inside day, on a quiet day, of what kind of moves you can still get on a day when the market itself was not all that directional, although it had some nice swings. So before I get deep into those tactical details, we've got enough new folks on board that it occurred to me I should do some more foundational work on the operational graphics, we call these, and the control measures. So in military planning, when you're developing plans, you start off with a 3-dimensional map, and you start arraying enemy and friendly forces, and you figure out where the objectives are and the key terrain, and you start trying to organize your battle space. And in order to have disciplined, controlled violence, we have control measures that we use to establish boundaries between units, limits of advance, left and right limits about where they can and cannot go when they have the ability to fire freely, how they're going to control fires across their boundaries so that we don't commit fratricide, and we can bring all our capabilities to bear. So it's been a 40-year habit of mine to put overlays of control measures like that on the operational area, or we would call it the battle space. And so after a while, you get used to looking at the operational map with those things on, and they have very specific meanings because of familiarity. And I often take for granted that what I'm putting on there, which makes sense to me, makes sense to everybody else. And so a lot of times it looks like a dog's breakfast the first time you look at it. And so what I want to do is go through this so you can see individually what the elements on the operational graphics are, so you can see how they contribute to my interpretation of what's going on. So with your permission, we'll do that, okay? So I just call this Building the Market Lens, and we're going to use April 16th, 2020 as our vehicle. So I'm just starting here with bar charts on the S&P on daily charts that goes back to the beginning of February, and through that quiet grinding upward move until about the 24th of February. So now the only things that I've added on here are the dragon, which is this thick orange ribbon, and then the ubiquitous MACD histogram, because I want you conditioned to look at those 2 things first all the time, no matter what, because that's what I do. So the dragon is named the dragon because it just looks to me like a Chinese serpent. And I'm reminded of the Chinese river dragons, powerful spirits for good in Chinese folklore. And it reminds the open mouth of this dragon looks to me, as it wiggles back and forth, it just reminds me of that creature, and it has a lot of power for me for sense making. And so my eyes are drawn to it, and the orange sticks out for me. So it's a 10-period Bollinger Band with a plus or minus 0.5 standard deviation on it. So that means it's one standard deviation from one side of the dragon to the other based on the ranges of the previous 10 bars. You can see when the market is quiet, the dragon is thin and price is very close to it. And then when the herd starts running, you can just feel the heartbeat and the adrenaline and the emotion as those bars get bigger and wider. And during directional moves, price will precede the dragon, which follows. And it almost looks like the dragon is on the flank, and it takes a special effort for price to get across the dragon, hold support, and then continue the other side. And so it just looks to me like if the price is a bunch of herd animals running along, that they're almost like running away from the dragon, and that it takes an act of real courage and a change in psychology to brave the journey across the dragon's mouth and get to the other side. Later, we're going to see how the river adds in there. That's going to be that 30 period Bollinger Band, and the dragon has so much weight to his body that he prefers the river, and the river is the source of water for those herd animals. And you'll see how when they make directional moves, they leave the river and get into a mad sprint, and the dragon moves to the edge of the river and keeps them out until they're so thirsty that they must bravely cross to get water and then get to the other side. And then in this one, as you can see, the metaphor is that once they cross to the other side, then their direction changes and the herd's going to run trying to escape that dragon, who then is going to swim to the other side of the river and then just pace them as it goes. And as long as they're on that side of the river and ahead of the dragon, they're just going to keep going until they're so thirsty they have to come back to Crocodile River, where if they spend a lot of time in the middle, they're going to get chopped up. That's the metaphor of the river, the floodplain, and the river dragon, and then price acting as a herd animal. Now, down below this, I just want you to notice how the MACD histogram, the MACD signal line, that is constructed with a MA of 10 and 30. So the fast MA is going to be 10. So the 10 in the MACD is derived directly from the 10 period simple moving average, which is the spine of the dragon. When we add the river to this, you're going to see that's a 30 period simple moving average. So in a very real sense, as we say in the base camp, or in the boot camp course, that the MACD is showing you the relationship of the center of the dragon to the center of the river. And it smooths that out. And then you can actually see the oscillations. You can see the turning points. And it gives you a very smooth seasonality of what price is doing. And yet it changes pretty quickly, because you'll notice here when the MACD line crosses over its 5 period moving average, and it goes from winter, you can see this entire period of time when it crosses the zero line all the way down here, price was just collapsing. So in the winter, you want to be short. And when it crosses over and begins entering the spring in this long grinding move back to the zero line, where it has just now become summer, that price action is more difficult in the spring, because you have all that psychology of the panic of the winter to contend with. So when it crosses from the fall into the winter, you absolutely are looking on the short side, and you're not trying anything on the long side, at least until you get into the spring. Now, we put this Red River Bollinger Band 10 period on the MACD, I'm sorry, 30 period on the MACD line itself, and that gives you sort of a noise boundary between the early spring and the late spring. And I like to monitor the z-score of where that MACD line is inside of that Bollinger Band, because that gives me some sense of how long we've been in that particular season and when is it coming back towards normal. And that gives me a way to a nuanced view of that time frame. So what I want you to notice then is the importance of the dragon, and I want you to understand, in my point of view, the importance I place on the dragon. And then I want you to notice the belly of the dragon. That actually represents the statistically significant turning point in the low of price action. That's the place where support is established. That was the limit. All of the price action that you see that's below the dragon, I assess as noise. The real center of the turning point was right here where my mouse cursor is, the belly of the dragon. All of this other price stuff was truly the emotional blow off. And I want you to notice that the belly of the dragon rolls up about the time it goes from winter into spring. And then I want you to know that when we talk about the owl formation, it requires the dragon slope to go from down to flat and then start to curl back up, which gives us enough time in the reversal for it to genuinely establish a new direction. So the purpose of the owl is to take advantage of the relatively slow nature of the dragon to turn. It actually takes significant price action before it really starts sloping upwards. So that's why that criteria is in the owl, to ensure that when we play the reversal to the longer term trend trade, that we're not premature. So that's the first set of overlays that goes into that market view. If I took the MACD and the dragon off, what you'd have is a naked chart just looking at price action, and you would have to make sense out of all of that yourself without any reference points. Adding the MACD and the dragon adds some mathematical rigor to this and standardized adaptive math to help us start placing meaning into the description of what we see. Okay, so that's that. Next thing up, if I could only add one more thing, then I would add the 10-period regression line, which is drawn as a thick blue line. I consider the MACD. I consider the moving 10-period regression line as the actual trader's price. What it does is computes the current 10-period regression line perfectly placed price for each bar. So it considers the current bar and the previous 9, draws the regression line that best fits those 10 bars, and then the endpoint in the 10th bar, or the current bar, is where that regression line would end up with. And that is, in mathematical terms, the correct price, the regression price. And then all of the tail of that candle would be considered error or noise. And so when it goes to the next bar, it drops off the previous 10th one and adds this new one, and then recomputes. Now that line would have already adapted and be about where my cursor is. Now you can see that on that sharp reversal, that entire bar is off of the line. But as the regression line quickly adapts, it gets back into a pretty good approximation of where price ought to be at any given time. And what this gives us is a mathematically precise definition of price. Now, the turning point in the RL10 is significant to me because that also acts as a mathematically precise support level. And so now, instead of choosing the absolute excursion of the lowest price in that bar as the support level, the regression line turning point now is something like in the middle and has a little more statistical value. So when we're looking at a long sell-off like this and we're trying to say where is the actual support, most people are going to draw that under the furthest excursion. But I draw it in two places, at the turning point, or the belly of the RL10, and the belly of the dragon, and each one of those is a more nuanced, statistically interesting description of where to predict the actual support will come in. So if we were to see the current price action, which has now recovered 2 legs up, and if it fails through the dragon, which will act as support, then the next support level is going to be the belly of the dragon, and then the belly of the RL10, and then finally the maximum excursion. So if we were using those as guideposts about how to get short, we would be getting short after it gets through the noise barrier of the dragon, and then somewhere between there and the belly of the dragon, which would be the pocket, or right at the belly of the dragon if that gets breached, or at the belly of the 10 and if that gets breached. And that gives us 2 to 3 opportunities to get short in this region before it breaks the final price level of the absolute excursion. So the RL10 acts as the fast regression line, or the trader's price, the trader's fair price. Acting at low regression line, the 30-period moving regression line, that constructed the same way as the 10, only it uses 30 periods of look back. And now you'll notice that is a very smooth sine wave. And if there was just one thing that I could trade, I would trade the 30-period regression line, the moving regression line. And the slope of that is the health of the market. So when it goes from sloping downward, we are in bear territory, or winter, if you will. And when it flattens out, there is a state change. While its price is mucking around and the RL10 has already rolled over and the dragon is starting to adapt, the slope of the 30-period regression line is a smooth, orderly progression. And then right about here, that thing starts improving and all is well. That acts as a very nice corral or a fence. And then you'll notice how it begins to catch up. Once price continues to move, it begins to accelerate. So this RLCO is the regression line crossover of the fast over the slow. When this happens outside the river, we have a P1, and that's the end of this phase. So when we start thinking about the owl pattern, there are 5 criteria. The first one is an unambiguous move. That's an unambiguous move. When the RL10 and the RL30 are outside of the river, that's the beginning of trending behavior. And then that's an unambiguous move until it makes a P1, or that RLCO, outside the river. Once the RL30 is outside the river, then we have the beginning of trending behavior, and that trend is still underway until we have a P1. And that's the first signal that we have that price has begun to consider reversing the trend. So in the owl, 5 criteria. The first one, unambiguous move. Second criteria, P1, the RLCO outside the river. The third criteria is the RL10 has crossed the dragon. So that happens in this bar. That's the third criteria. He's in the pocket that is formed by the bend in the dragon. Think of that like an elbow. And that little curve, that's the pocket until it takes out the previous high, which was way up here at the hump of the dragon. You know, the hump of the 10 and the hump of the dragon. So this entire region is a pocket entry. The unambiguous time to get long is if price takes out this previous high, and then all of this price action would have been negated. But there's a good reason to want to try to get in before it takes out the emerging dragon. When the dragon gets above his previous hump, he is an emerging dragon, in the same way that this was a collapsing dragon. And if price were to fail here and get below the belly of the dragon, that would be a collapsing dragon, my favorite pattern of all. So this area where the letters SPY are is the pocket going north. And then this area underneath the dragon until it gets to the belly of the dragon is the pocket going south. So the RL30 now acts as a very smooth, slow regression line. Beautiful. The slope of the RL30 is the slope statistic. I measure that and study it carefully, and that is my um, indicator to show me the health of the market. And so when I look at the slope stat on the daily report, when we get to that, that's what I'm measuring, is the degree of slope at each point in the RL30 as it rolls over. I want you to notice that by this time, by the time the RL30 has rolled up, we've gone all the way through the spring, through the Red River, and now we're into the summer, and the RL30 is good. So when we think about the 5 criteria of the owl, what we're going to see is, number 1, an unambiguous directional move. 2 is an RLCO, in other words, a P1. Number 3 is the RL10 has crossed the dragon, RLXD. The 4th criteria is the dragon belly has started to slope up, and that happens right in here. Shortly after the RLXD, it happens right in this region. The 5th criteria is an upward slope of the RL30. Those are the 5 criteria of the owl. And now you can buy a candle breakout. So this third bar in here would have been an owl entry because it took out the previous high at that tick. And also even the second bar, I would accept an owl entry in here because both the dragon and the RL30 are up. And this one took out the previous hump. So what we do is we buy here or here or here. Any one of those 3 prices is acceptable as an owl entry. And we place our stop either below the belly of the dragon or the belly of the RL10. I prefer the belly of the dragon and just get on with it. And you'll notice that owl paid off nicely. So those are the 5 criteria of the owl, and that's the life cycle of the seasons of MACD histogram and the life cycle of these large, strong directional moves. Notice 1 leg down, 2 legs down, 1 leg up, pause, 2 legs up. So you see 1, and then you plan for 2, and then you hope for 3. So where we would have seen on this first leg down that once you see this sharp sell-off and then it recovers, it doesn't even get through the dragon. And when it rolls over again, right about in here, you're short, and you're looking for the second leg down. And the way we estimate that is that the size of the first leg, we just clone, cut and paste, and we project that it should get down to here, which it did quickly. And you could argue that this little rebound was the end of the second leg, and then this is the third leg. I wouldn't dispute that. So even if you had covered in this reversal bar, you'd have gotten short again here and enjoyed this ride down. So I'm not going to quibble whether that's 2 or 3. And now you can see the value of the RL10 as a smoothed price. It gets you completely out of all that argument about is it or is it not a reversal and where's this? No, look at this. Look at the blue line. That'll tell you something. The slope of the blue line, the slope of the black line, what the dragon is doing, dude, it's going down. We're deep in the winter. You got no business trying to get long in here. But now the seasons have changed, and the herd is thirsty, runs across. So that's how you interpret that one. Now what I'm going to do is add a measure of long-term value, long-term fair value, by looking at the moving RL270. So if you remember, the RL10 is the fast regression line, times 3 gives us the slow moving regression line, times 3 is going to give us the 90, which I haven't plotted yet, and then times 3 gives us the 270. So that's like the slow regression line 2 levels higher. I treat that as the long-term fair value as defined by long-term buy and holders on whatever timeline I'm looking at. So whatever my chart is built on, in this case it's daily, but it could be minute charts. The blue line, the RL10, gives me my definition of price. And then the RL270 is the slow regression line in the slow pair. The 10 and 30 are the fast pair, the 90 and the 270 are the slow pair. So the fast is the RL10. That's the fast regression line in the fast pair. The slow is the slow regression line in the slow pair. The 90 and 270 is the slow pair. So the difference between the RL10, the fast trader's price, and the RL270, which is the slow long-term holder, that's the difference between the aggressive trader and the long-term buy and holder. Now, way back here, when the RL10 equaled the RL270, both of those parties agreed that that was the correct price and the fair value for that instrument. And then we see how far the RL10 is able to push price. That's how powerful the traders are. That's how much money and influence they have to move price away from long-term fair value. And during this entire move down, the long-term buy and holders began slowly to think maybe there was something to this, and slowly made micro adjustments to their posture until the traders ran out of money, and then new traders came in and saw the difference of opinion between long-term fair value and the current price, and now say, oh, we can buy quality on sale, the S&P 500. Civilization, it turns out, is not going to end. And so now there's this mad rush to buy, pause, and a second wave. And now you can see the RL10, the trader's price has come very close to coming back to the adjusted, adapted long-term fair value, which has come down to about 300. It used to be as high as about 325. So it's come down about 10%, slowly, gradually, incrementally. And now we can actually begin to assess the difference at any point in the curve between traders and holders. And so when we study this in the regression line fractal framework, what we're doing is measuring for each instrument historically the power of the traders to move at a certain distance, and then we can study that and then describe how powerful each current move is with respect to where it was in the past. And then we can actually measure the difference between the RL10 and the RL270 and express that as a number of ATRs. And we can use that as an estimate of the opportunity. And so this is probably about 8 ATRs away from price to fair value. And I could let it come back 1 or 2 and still have 6 or 7 ATR just to get back to fair value. And I can use that to rapidly frame favorable reward to risk swing trades on daily charts. I can also use this fractally intraday and then substitute the VWAP for the RL270 or add the VWAP to this intraday, and I can estimate the VWAP magnet move, and you'll see me doing that quite frequently. I can also use the RLXD as an opportunity to get long. This is about 2 ATRs down to here and probably 5 ATRs to there. That's a 2.5 to 1 reward to risk, and I can buy it with the stop at the belly of the dragon, and then I'm good to go. So the RL270 then gives us the ability to do the RLFF, regression line fractal framework. Now I'm going to add the RL90, and that's an intermediate regression line. I use that as a checkpoint on the journey from the reversal of the RL10 back to the RL270. You notice that this acts like a series of road signs now on a dangerous, slippery when wet road. Price peaked, reversed in the RL10, made a P1, entered the dragon, crossed the dragon, held support at the dragon, crossed the RL90, and is now closing in on the RL270. We had the RL10 reversed, the RL30 reversed and rolled up, and that gave us the owl entry in here. The RL90, you now notice, you see the RL10 cross the 90. The the 30 is now getting ready to cross the 90. That's like a 1030 crossover on one time frame higher. That's the intermediate pair. This is like a P1 on weekly charts. And now you can see that longer term trend reversal simply by looking at and interpreting the regression lines in a series of pairs. You have the 1030 pair, you have the 3090 pair, and you have the 9270 pair. So you have a fast, intermediate, and slow pair. And these are fractal in nature, and they give you insights into the higher time frames on a single chart. And notice how much information is now conveyed with just those charts. And that's why I turn off the candlesticks, so I'm not distracted by fat candles and bright flashing colors. I'm looking at the blue line for price and interpreting price trends like the tides of the ocean, rising and falling with the 10, 30, 90, and 270. Now I'm going to add the PSAR, which is almost like little mountain climber safety points in here. I'm using the 0.02, 0.12. This one is based off of price action. I modify that a little bit to be a little bit slower, a little bit safer, and now I'm using the PSAR off the price itself. So it is slower to react, but then smoother and more powerful. I want you to notice that when the PSAR flips, in this case, it flipped right in the middle of the RL30 rolling over. So while the RL30 was neutral, the PSAR flip told you, yeah, it's time. And so that's a little more relaxed than the PSAR flip back here, which gives you the same information as the P1. So I like using the PSAR on what I'm calling price, which is the RL10. And then that gives me an intermediate turning point. And then when the 30 actually rolls over, we're already well into the turning point of price action. And then you'll notice that the RL10 and the original PSAR flip price level mathematically are going to be identical. And then you'll notice that when the RL10 crossed the dragon, it also triggers a PSAR flip. So you get multiple confirmations from different mathematical treatments that start giving you information upon which to base your judgments. Now lines in the PSAR off, and I'm showing the volatility envelopes that are created by the Bollinger Bands, and I use 30 period look back because I want something that's statistically significant. Traditional is 20, but I'm using the 10 for the dragon, which I've left on, and I'm using 30 for the river plus or minus 1, the floodplain plus or minus 2, and then this outer red boundary is plus or minus 3. I want you to notice how that river dragon swims, and he's always got 1 foot in the water until an extreme move gets him out. That's so unusual that tells you how extreme this move was. And then when price got across the dragon and swam fast through Crocodile River, this red line in the middle is that 30 period simple moving average. And now the relationship of the Bollinger Band mean, the middle of the river, and the spine of the dragon is expressed in the MACD 1030, which is the fast moving average is the 10, that's the spine of the dragon, and the 30 is the middle of the river. So I want you to notice how the dragon in an extreme move will swim to the side and then is in the middle of the river, and now he's on the far side of the river. And now the herd is either going to stay in here or is going to get chased out by the dragon and then make that run. And now we have a price ladder of Z1, edge of the river, Z2, edge of the floodplain, Z3. That's the discontinuous price. Any move beyond Z3, in this case about at 320, is classified as abnormal exuberance. That is a change in psychology that is dramatic. There's a lot of pressure on the indexes, especially to revert back to the mean. So these are harder and harder to breach. And so a price action that moves through there is significant. Now when I put the regression lines and the PSAR back together, now I have combined this appreciation of volatility envelopes and then the price interpretation of the regression lines into that overlay. And now it's starting to get a little more complex. This feels natural and normal to me because I've looked at it this way for 20 years. And now I start adding in these interpretive graphics that help me refine specific price levels that are important to me. I've made thick red lines where I consider important support levels. In this case, I'm showing the skin of the dragon, the PSAR flip, and the 10-day low, the belly of the dragon, and the belly of the RL10, and then the 30-day. Those price levels to me are extremely important, and if breached, are significant. The thinner red lines are just checkpoints on the way. Similarly to the upside, leaving the river is significant. Crossing long-term fair value would be significant. That's that purple line. Breaching the 30-day high would be significant. Getting all the way back up to the hump of the dragon and the hump of the 10, that would be the emerging dragon is thus significant. I've now added in the 1-day, 10-day, and 30-day range because those feel significant to me when interpreting the actions of fast and slow swing traders. And then I've put these reference points of 10% sell-off chunks so I can get an appreciation for the absolute feeling of pain that comes from percentage losses. How bad do they feel? And then I have this black line showing the price. And then I have this blue line showing where it opened the week and then where we are. And then I've labeled the MACD histogram and focused where we are and reminded myself when I have a long side bias and when I have a short side bias. And we're in the summer, so I have a long side bias. And then I've marked off, based on my assessment, I've added this yellow zone because I don't really see much resistance in here. And if it couldn't get through there today, but if it does, it seems to me there's potential for a third leg up that could run through quickly. Now, the extra bit of dog's breakfast that I've added, and I said all the previous stuff just so that you could have a point of reference for what I'm about to cover now. Now I want you to notice the 3 thick blue circles. And in those blue circles, I've almost carefully hidden the fact that this is where the RL30 crossed the SMA 30. So the that 30-period regression line was north of the Bollinger Band mean and then crossed. That's the end of the bullish move and the beginning of what could be a bearish orientation. And that thing stayed south all the way through this life cycle, and now today crossed the Bollinger Band mean. And all it needs to do to begin trending behavior on the long side is for the RL30 to leave the river. I've projected that in about 3 days it could do that unless price collapses, and that will be the beginning officially of long side price action. So all I did was extend the slope of the RL30 here and then extended the declining skin of the river here. That's where they're going to meet, and that's going to happen in about 2 or 3 days. And as long as this price action doesn't collapse, then that's going to be confirmation that there's some legs to this thing. Conversely, I'm giving it about 3 days of expectation. I said, look, guys, if you're going to move it north, now's the time. You've had 3 days of selling off, of failure to follow through. You got about 2 to 3 more days to get out of this zone of indecision, or it's not going to be a clear-cut runaway upside move. So that's what those 3 thick blue circles are looking at. I'm looking at the relationship between the RL30 and the SMA 30 as a way to estimate that intermediate strength of trend. The last thing I want to cover on this chart is I want you to notice now what I've marked off is this big orange block. And at the peak sell-off, that represents the size of the power of the traders to move it from away from the RL270. So that measures from the very bottom of the RL10 all the way north to the RL270. That's how much power the traders had to move it. These other ones in here are references. On the simple leg, they moved it from here, 325, down to here at about 295. So that's 30. That's a 10% move. They were able to move it on one leg. And then they moved it a second leg, 10%, and another 10 or 15%. So that was like one chunk is a 10% leg, especially coming out of end of February when all was well. All we had to do was impeach a president. I'll answer your question in a second, Kim. So at the peak sell-off, that's how much power the traders had to move it. Now, on this first leg back, it paused right here. And so I then measured this distance. This is how much power they had to move it from here to there, about halfway. And then there's another leg up to get from here to here. That's actually the opportunity that when I'm framing trades inside here and using, say, the belly of the dragon, or in this case, the belly of the RL10, I'm really estimating this move here to be the not surprising move back to fair value as a swing trade. And now where we are, prices closed all the way at the RL10 from here to the declining RL2. That's how much left is upside on the first piece. Now, the other thing that I've noticed in the RLFF framework, the regression line fractal framework, that if the traders had this much power to move it in one direction, that when it makes this recovery move, it never surprises me if it moves beyond. So let's just see how that might help us make estimates on the far side. Look what happens. I take this size move, I clone it, and then say how far past the RL270 could it get on the first run? Oh, this far. It would get through the RL30, and then that relief would take it this far, which takes it back to the previous RL270 fair value, and then all would be well. So when I'm looking at the upside potential here, I see 325 as a reasonable relief rally that if it can break through the 10-day high, it can get to here in 2 steps without much debate from me. I then go back to this first 10% sell-off. I clone that and I say a 10% move beyond this fair value would get it back to the hump of the dragon. And then I go to this almost 20% move from this leg and say, that size move is this size move. Now, I will tell you that if it gets through the hump of the dragon and the hump of the RL10, the next thing that happens is one of these moves, because all will be well. This will all be smoke and mirrors, and everybody will be saying, you see, I told you so. I knew it would come back. Now, the Ken Hum asked me, what about these, on the side you see the volume at price. I consider those are like the market profile. That tells you where people were making the exchange of value. So you'll see a big, thick, strong one here. That's why these two support levels are so strong, because so much volume was changed right here. That's where a ton of people bought in this price level. And so if that gets violated, all those people are wrong, and they're going to panic and try to get out because they can see this price coming down. So that's why I mark that off as really strong support. And this one here at the skin of the dragon correlates with all this price action on this big volume at price bar. So that's why these are really significant from volume at price, but also statistically based on the price levels that are indicated by statistics on price action. So that's what goes into reading the market health check, and that's the first thing that I do each and every day. And that informs my longer term market classification, market mosaic, if you will. And that's now I'm finally ready to talk about today's price. Hooray. Thank goodness. Now you know. So now when I look at today's price action, I see, let's let's see if I can shift back to the, so you can see my cursor. Hopefully you found that instructive. You'll hear a lot of that material on the in the boot camp, but sometimes it's easier to see it on a chart as you build it and hear the narrative fresh. That's my theory. All right, so now what we have was today's price candle. Here was the 1 day. Here's the 10-day range is still in play, the 30-day range. This is like a sideways quiet channel that is now coming into the dragon, and this little cluster, this little traffic jam coming to a head right in here. We've had 2 days where the market did not follow through but did not fail. It tried to fail both days and then recovered at the edge of the dragon, but it was dicey today and caused me to exit some swing trades because I couldn't take the heat of the potential of that collapse. It recovered well, but this market is on notice. I'm ready to get long and strong once more if it breaks through this 10-day high. But I'll be tactically trading with hybrid frogs because we're in bare normal conditions at a critical state, and I'm going to be an intraday trader first, and you'll hear me express that in the speed run. So that's where we are. The speed run describes this in greater detail. This is what I plan to. We're an hour into this, so I'm gonna. I'm going to go ahead and go through those 6 swing trades or the intraday trades pretty quickly. I'm not going to go the same bar by bar that I've been doing the last, 8 or 9 days. But I'm going to almost speed run through there so you can see what it looks like on different dimensions. So let me finish the daily market stuff. Just quickly, the S&P was here, up 0.4. What was better than the market today? Emerging markets, Home Depot, Apple, McDonald's, Treasuries, tech, Caterpillar, Tesla, healthcare. Walmart was massive today. The best in my stack, 2.7. And Wheaton. That's why I traded Walmart today, because it was leading the way all day. What was worse than the market today? EFA, diamonds, Cisco, materials, U.S. steel, timber getting worse and worse. Mexico, clean energy. The Russell was down minus 0.8 on a day that the market was up 0.4. So the traders are running out of patience for this upside move. They're playing tactical in the trading environment, and that's why this thing is slowing down. Real estate, oil, finance, Brazil and Mexico really weak. Now listen to the things that collapsed today. Chevron, Alcoa Energy, Devon Energy, Cliffs Natural Resources down 7%, Boeing down 8%, Virgin Galactic down 9%, Simon Property Group, commercial real estate down 13%. You've heard me talk for 4 weeks why I think they're doomed. And today was easy to believe in their failure. And that's why you'll see that one on a speed run, smashing it on the short side. Quickly, in the auto framer, these are the ones that test out well on a mechanical entry for and a test of the 10-day high. Things like oil, Morgan, Caterpillar, American Express. These are all the things that got smashed and are far away from their 10-day high, but had relatively small ranges today. And that gives you this massive favorable reward to risk ratio if it resumes tomorrow. Could that happen in a bear market? All the time you get 1-day pops, dead cat bounces. That's why these are very attractive for short-term swing trading 1 day at a time. On the look at these on the squeezes. These are the ones that are especially good for one-day pops. They have large average ranges. They had very tight ranges today. And in that difference, you get, if you just use today's range as your unit of risk, and then it just makes a range stat move, you get these kinds of payoffs. Almost 7-to-1 in treasuries. The S&P itself is almost 4-to-1. That tells you how tightly compressed the market is. It's waiting to explode in either direction, which is exactly why I call this such a critical state. You have this coiled spring, an inside day, tightly compressed. It closed where it opened, collapsed down through the dragon. If it collapses through the dragon, bam, down it goes. And all of the pain and suffering that happened here is just baked into the cake, ready to bite us right here. So I have no belief long term in this market. Richard asks me, would I be buying it overnight, and would I have to buy it earlier today? No. If you did, you got to use like a 2 ATR trailing stop so that your position size isn't crazy. What I would much rather do is this: have that symbol that's in that condition. I'd like to intraday trade it, make some money on it, and then keep 1/5 of the position in the direction that it was closing. Those are the only circumstances under which I would hold that, because I have earned markets money in it, and psychologically I'm willing to risk that. I am unwilling to risk my seed capital in a bear market when we've had such an extraordinary sell-off, and there's such a strong case for this thing to collapse. Personally, I'll tell you what I want to see is another collapse that goes all the way back down. As a trader, I love a move back down here to test this again, because this was my best month since 2009. And I want to see that again for my own selfish, greedy intraday trader greed. That's a horrible thing to say, but that's who I am as an intraday trader. As a swing trader, I would love to see people recover and get up to here, and I hope that's what happens with my rational, mature, adult citizen mindset. And I'm ready to play that. The only way I'm doing that, though, is if it starts off intraday and makes that move until we get out of the bear and at least into sideways and bull on market conditions. That's what happens if we get above this green line. Until then, I am a tactical street fighter jungle animal in all my trading. That's my mentality. I am not going to get killed in that market, but I'm gonna kill the unwary and the herd animals that are not paying attention. That's what I do. Boy, does that sound evil. But anyway, there you are. All right, so quick speed run. I'm going to get through this in about 20 minutes or less. Okay, so this is the Dow. I want you to see what a beautiful intraday oscillating yin yang symbol the Dow is. Boy, is this smooth and orderly. So here we are. It opens 1 minute charts. It moves a hybrid frog box off the VWAP. Let me get my cursor. So the VWAP was here. The long-term fair value was there. It moved that far down. I'm short when it crashes through the PSAR. Yay. Second one, collapsing dragon. Third one, collapsing dragon. Covered. Bank. RLXD. Second leg up. That's a dragon entry. My stop is at the PSAR. Bank. Short. That's a pocket reversal. The size of this move on the way down, hey, I'm willing to try this because it could get back to the VWAP. It didn't. Cash short because now this is the second leg down. It could come all the way down to here. The size of this move is the size of this potential move. So short. All right. Sorry, didn't work. Out. Relax. Long. It crossed the VWAP, held the pocket, held support, second leg up. I was so massively committed to the downside. I didn't stop and reverse there. I wanted to see what happened when it got here. Oh, it started moving up. Okay, long. Initial stop at the PSAR. Second position when it clears all this crap. Second position in. That rolls over. Scratch the second one, and I'm all out of everything. So bank. Short. Collapsing dragon. Cash. Done. This is triple short oil. So when oil's crashing, this thing goes up. There's our little, it had a little gap up and the VWAP, gets to the crest of the RL10, starts to roll over. I draw my little manageable risk box in there. Now it's game on. Long, why? Rolled up, rolled down, reversed above the VWAP, takes out the previous hump, emerging dragon long, stop at the VWAP. Second position, third position, scratch, bank, short, cover, long on the crossover, cash, long again, reentry, scratch, and fractional loss. Try it again, scratch, long again, god damn it, pardon my language. Second one, covered. So got paid early and kept pushing it and not sticking around, but ready to get right back on. Pardon my language, it was unprofessional. Wheat and precious metals. Gaps up. Here is the Z3 excursion. I draw my little my Z3 box in here. Wheaton is already better than the rest of the market. Breaks out. Z3 breakout, long, scratch, long. Second one, covered. Long again in the pocket and that elbow, that's a continuation pattern. You know, the RLXD happened here, so I get out. It reversed north of the VWAP, north of the RL270, crossed again, get right back in. So I've essentially just re-entered here, but I made bank on this first one. So I've only got one position long because it's already showed me one adverse move. So I'm a little more reluctant. Bank. God dang it. I wanted to get short. That's a collapsing dragon. Didn't have the will. God dang it. It broke through the VWAP. I didn't have the will. Okay. Recovered. RLXD, this is now an owl entry. We had an unambiguous move down. P1, cross the dragon. Dragon rolls up. The 30's rolling up. That's an owl. It's in the direction of the trade that I got big paid on. So, okay. Live with it. Cash. Bank, if you will. Try it again. It held support at the same level it did before. I just replicated that same trade. Bank. If you don't want those, I'll take them. Missed the collapsing dragon, no will. Tried it again. Bank. So 3 banks, 2 good paydays, one scratch, and 4 little banks, if you will. Making bricks. Cleveland Cliffs. Remember how smashed the Materials and U.S. Steel and Alcoa and Nucor Steel were. This one gaps up, starts selling off, makes a manageable risk box move to the south. Materials suck, short, scratch. Try it long. It feels like an owl. Scratch. I was slow to get back in because I had two in a row. I'll try it. Short. Scratch. Man, what's a guy got to do to get paid around here? Keep trying. Long. Scratch. Short. Z3 pinch coming up. Here we go. Short. 3. Paid. Persistence. Hey, you don't get cards, don't play the hand. Next. Virgin Galactic. Mucking around in a sideways quiet channel. This is that speculative long. I only want it long if it's working. The rest of the market was collapsing. It sucked compared to Tesla and the rest of the market. Short, scratch. Tried long on the RLXD and a Z3 breakout, scratch. Short again, collapsing dragon, scratch. God, what's a guy got to do? Short. This is the same time the rest of the market was suffering. Short and covered. Short, second, third. I got paid big on that one later, so we got to exit. We ended up covering way down here, around 17, so it's like down in here. So that finally paid off big. Don't lose much when I'm wrong. I like try to live by that. This is UDow, triple Dow, short, second, covered, long on the owl, bank, long again, re-entry, bank, re-entry, bank, short on a, this is rolling over. That's an owl short. You can feel it rolling over. Look at the Z3s pinched and rolling over. The RL90 was rolling over. This was scratch. Long, why not? Just keep trying. Now it feels like it's up, scratch, short, slow to get in. Waited for the waited for the VWAP to crash. Bank, long, owl, bank. So remember, this was this turned out to be an inside day. If you think I'm thinking hard about these intraday, I am not. I am not thinking about it. I am trading these. Last one, Walmart, best symbol in the stack today. Here is the manageable risk box, gapped up, a high and a low. Long and half an hour loss. There's me losing money going long on the strongest symbol of the day. Z3 pinch, now Z3 breakout, try it again. Second one, third one, bank. I'm not getting short the strongest symbol in the stack. Long on the RLXD, resumption of the trade. Second one, when it takes out the previous hump of the dragon, bank. Long, scratch, done. Later in the day, this is, so you saw me do the, that morning session. Whoops. You saw me do the morning session with oil, or the inverse oil. This is what happened in the afternoon. So the tactical trade is over. Now I want you to notice that the RL 270 crossed the VWAP, went all the way higher. Now all the price is leaving that alone. Look, the price is rolled over, the 10 is rolled over, the 30 is rolled over, the 90 is rolled over, and now even the 270 is rolling over. That run is done. This is where it started at the VWAP at the start of the day. 0.9 is the not unreasonable target on the downside. For it to get there, it would have to go as far. Look how far above the VWAP it got. If you double that, how far to the other side? All the way back to where it started, where it opened. That's tactical trading geometry. Takes me a while to get into that one. Short, collapsing dragon, cover, immediately reshort on the collapsing dragon, bank, short on the Z3 pinch breakdown, and covered because we're close to the end of the day. So traded both sides of that mountain, and look where it got to. Exactly as far below the VWAP as it had gotten above the VWAP intraday. That's that regression line fractal framework and symmetry. On intraday, I like the VWAP because it acts like such a powerful magnet for leveraged intraday positions. Swing trading, I like the RL270 as that measure of long-term fair value. But I use kind of both of them intraday. But the VWAP is really important to me. All right, so we're about an hour and 15 into it. That's the speed run of those 6 or 7. Look at how many different price action patterns there were. I put all 6 or 7 of those blank trade frames in Patreon. You can download those and practice on them, and then I will upload the marked up charts as a secondary batch. Those ones are labeled as something something blank. These are labeled as something something series, and that gives you kind of like a before and after, sort of a check on learning. And what I like about that particular batch, just happened to work out that way, is that we saw strong stocks, weak stocks, we saw oscillating stocks, we saw big reversals, we saw lots of sticking to it and staying with it. And I was better on my exits today than I have been earlier this week when I was sloppy about being around too long. I'm starting to listen to my own advice there on especially as we come tighter and tighter into these critical states. I've got to be sharper and sharper on getting out of the positions. I don't have to be right. I cannot afford to stay wrong too long. Words to live by. Okay, so thanks, guys. I'll get this processed and posted. The speed run and the portfolio review is already up on Patreon for your viewing pleasure. So thanks for hanging in there. Appreciate your hard work and attention. Let's get after it. Let's be these next 2 days. Tomorrow, Friday, going into the weekend, I think is a showdown at the OK Corral. I really think tomorrow is the day they decide, are the longs going to hold this over the weekend while we're hearing more and more divisiveness about politics and the economy and recontamination and all that jazz? I don't know. So I think tomorrow's showdown day. So I'm going to be ready. Take good care. Wash your hands. Stay off the beach. Love your family. Be gentle and forgiving with yourself, but be ruthless about your serious profession. Be a serious person and approach it that way. So thanks so much for your support and patience, and we will see you in the chat room. Yeah, I don't, Victor, I don't know. I think it was more of the internet connection rather than the software. We've had some really bad weather the last couple of days, but it cleared up like this afternoon, so it's crystal clear outside. And so I've got 2 different satellite internet connections and 2 different cell phone net connections. And so the one I used for tonight was the one that I didn't use during the day. So maybe they're rewarding me for not using up bandwidth. So we'll see. Maybe that's the explanation. All right. So anyway, take good care, and we'll see you on in the chat room and on down the road. Thanks, guys. Yeah, there was about 2 or 3 good lessons in there today. I'll have to parse those out and turn that into standalone lessons. Just gotta hire somebody to do that for me. I'm so darn lazy. Take good care.